Most people think trading is the fastest way to get rich. That belief is exactly why they lose money. They stare at screens all day, chase candles, follow tips from strangers, and call it strategy. But the market doesn't reward excitement. It punishes impatience, ego, and ignorance. The truth is simple and uncomfortable. The more you trade, the more you pay in fees, in taxes, and in mistakes. Professionals know this. Institutions know this. Yet millions of people keep doing the opposite because it feels like control. Chabinda, if you've ever wondered why smart people still lose money in markets, stay with me, because what you're about to hear could save you years of losses. Trading is designed to exploit human weakness, and that's the part most people never want to admit. They believe losses come from bad luck, bad timing, or bad advice. In reality, losses usually come from something much closer and much harder to confront: human behavior. Markets don't move based on what feels fair. They move based on incentives, information, and psychology. And human psychology, especially under pressure, is deeply flawed. When people start trading, they think it's a test of intelligence. They believe if they study enough charts, watch enough videos, or follow the right experts, they'll figure it out. But trading is not primarily an intellectual challenge. It's an emotional one. Fear, greed, ego, impatience, and the desire to be right all show up the moment real money is on the line. And once emotions enter the equation, rational decision-making quietly leaves the room. The market is not emotional. It doesn't care if you're confident or afraid. It doesn't reward effort, hope, or intention. It simply reacts to supply and demand, to capital flows, and to information that often moves faster than any individual can process. Yet traders sit in front of screens, watching every tick, convincing themselves that reacting faster equals being smarter. What actually happens is the opposite. The faster you react emotionally, the more predictable and exploitable you become. Dan, this is why trading environments are built the way they are. Bright screens, constant price movement, instant execution, notifications, alerts, breaking news. Everything is designed to keep you engaged, stimulated, and active. Because activity generates volume, and volume generates profits for everyone except the person clicking the button. The system doesn't require you to be right. It only requires you to keep trading. Fear is one of the first weaknesses the market exposes. Prices drop, headlines turn negative, and suddenly logic is replaced by panic. People sell not because the fundamentals changed, but because they're afraid of losing more. Then, after prices stabilize or rebound, regret sets in. That regret turns into overconfidence the next time. I won't make that mistake again, they say, and that's when greed takes over. Greed is even more dangerous than fear because it feels justified. A few wins convince people they've cracked the code, they increase position sizes, they trade more frequently. They stop managing risk because they believe they're in control. But markets have a way of humbling confidence. One unexpected move, one macro event, one shift in sentiment, and those gains disappear faster than they were made. The emotional swing from confidence to despair is brutal, and most people are not equipped to handle it. Ego is another silent destroyer. Traders want to be right. They defend bad positions because admitting a mistake feels like admitting failure. Instead of cutting losses early, they double down. They look for information that confirms their bias and ignore everything else. The market doesn't reward stubbornness. It punishes it. Yet ego convinces people that holding on longer is strength, when it's often just denial. Impatience may be the most common weakness of all. People want results now. They want daily wins, constant progress, and immediate feedback. But wealth is built slowly, unevenly, unevenly, and often quietly. Trading promises excitement and speed, which is exactly why it attracts people who should be doing the opposite. The market rewards those who can wait, not those who need constant action. What makes this even harder is that occasional success reinforces bad behavior. A risky trade works out, and suddenly the lesson learned is the wrong one. Instead of recognizing luck, people credit skill. This creates a dangerous feedback loop where losses are blamed on external factors and wins are attributed to personal brilliance. Over time, this mindset becomes expensive. Professional institutions understand these weaknesses very well. They build systems, rules, and processes specifically to reduce emotional decision-making. Risk limits, position sizing, long-term mandates, and committee-based decisions exist for a reason. Not because professionals are smarter, but because they know they are human. Information is not an edge anymore. Go. One of the most dangerous beliefs in modern trading is the idea that more information leads to better results. People assume that if they just read more news, follow more accounts, subscribe to better alerts, or add more indicators, they'll gain an advantage. That assumption used to be partially true decades ago. Today, it's almost entirely false. Information is everywhere. Prices move in milliseconds. News travels instantly. Earnings, economic data, geopolitical events, and central bank statements are absorbed by the market before most individuals can even react. By the time a headline reaches a trader's screen, it has already been analyzed, debated, and priced in by institutions with vastly superior resources. To manage this creates a brutal reality. Having information is no longer an edge. Acting on public information after the fact is not insight. It's participation in a crowd that is already late. Most traders don't lose because they lack information. They lose because they overestimate the value of the information they have. Dowson, the illusion of edge is reinforced by modern tools. Charts look sophisticated. Indicators feel scientific. News feeds feel powerful. But complexity does not equal advantage. In many cases, complexity creates confusion. When too many signals compete for attention, decision-making slows down or becomes reactive. Traders start seeing patterns that aren't there and meaning where none exists. Markets are not puzzles waiting to be solved by individuals scrolling faster than everyone else. They are competitive ecosystems dominated by large players, institutions, algorithms, funds, whose job is to process information at scale. These players don't rely on headlines or technical patterns alone. They rely on capital flows, long-term positioning, risk management frameworks, and time horizons that retail traders rarely consider. This is why reacting to news is so dangerous. News feels important, urgent, and actionable. But most news explains the past, not the future. Prices often move before the news becomes public, not after. When traders act on headlines, they're usually responding to a story the market has already moved on from. There's also a psychological cost to information overload. Constant exposure to opinions, predictions, and forecasts creates noise. One analyst says buy, another says sell. Confidence erodes. Conviction weakens. Conviction weakens. Traders jump from idea to idea without allowing time for any strategy to work. Information, instead of clarifying decisions, paralyzes them. Professional investors are extremely selective about what information they consume. They filter aggressively. They focus on signals that matter over long periods, fundamentals, valuation, balance sheets, cash flows, and structural trends. They understand that most daily noise is irrelevant to long-term outcomes. Retail traders often do the opposite. They drown in noise and starve for insight. Another misconception is that speed equals intelligence. People believe that acting quickly gives them an advantage. In reality, speed mostly benefits those with infrastructure designed for it. For everyone else, speed increases the likelihood of mistakes. Acting fast without a structural edge is just reacting under pressure. The real edge in markets has shifted away from information and toward behavior. Patience, risk control, time horizon, discipline. These are not flashy. They don't sell subscriptions, but they matter far more than knowing the latest headline or indicator setting. Judgment is the scarce resource now. Knowing what not to act on is more valuable than knowing what just happened. The ability to ignore irrelevant information, stay consistent, and avoid emotional decisions creates far more value than being the first to react to news. This is uncomfortable for many people because it removes the illusion of control. If information isn't the edge, then effort alone doesn't guarantee success. Watching markets all day doesn't make you smarter. It often makes you more anxious. Anxiety leads to poor decisions, and poor decisions compound over time. Find institutions spend less time chasing information and more time managing exposure. They know that predicting every move is impossible. Instead, they focus on positioning themselves to survive mistakes. That mindset is completely different from the retail obsession with being right on every trade. Another problem with information-driven trading is hindsight bias. After a move happens, explanations flood in. Suddenly, everything looks obvious. This creates false confidence. People believe they understood the move even though they didn't act on it. That confidence carries into the next trade, where reality usually intervenes. Markets reward consistency, not cleverness. They reward those who can maintain a sound process through uncertainty. Information does not replace process. In fact, too much information often destroys it. Activity feels productive, but it destroys returns. One of the biggest illusions in trading is the idea that activity equals progress. People feel productive when they're doing something, placing trades, adjusting positions, reacting to news. It feels like work. It feels like effort, and psychologically, effort feels like it should be rewarded, but markets don't reward effort. They reward discipline, patience, and judgment, and excessive activity is usually the enemy of all three. Most traders confuse motion with progress. They believe that if they're not trading, they're missing opportunities. In reality, most opportunities are missed because people are trading too much, not too little. Every trade has a cost, some obvious, some hidden. Commissions, bid-ask spreads, taxes, slippage, and timing errors quietly eat away at returns. These costs may seem small in isolation, but over time, they compound in the wrong direction. Blend professional investors understand this very well. They don't wake up every morning asking, "What can I trade today?" They ask, "Is there something so compelling that it justifies action?" Most days, the answer is no. And that's not laziness, it's discipline. Waiting is not a passive act. It's an active decision to avoid unnecessary risk. Retail traders, however, often feel uncomfortable doing nothing. Silence feels like falling behind. Stillness feels like weakness. So they trade to feel in control. Ironically, that need for control is what causes the damage. Markets are complex systems influenced by countless variables. Believing you can outmaneuver them daily through constant action is not confidence, it's arrogance. Overtrading amplifies mistakes. A single bad decision can be manageable. 10 small bad decisions, repeated daily, become devastating. The more trades you place, the more chances you give randomness to work against you. Even if you have a slight edge, which most people don't, excessive activity can erase it entirely. Taxes are another silent killer. Short-term gains are often taxed at higher rates, turning small profits into even smaller net returns. Losses, meanwhile, still hurt just as much. People rarely calculate how much of their trading success is actually being handed back. When you factor in taxes, many active traders are running uphill with extra weight. There's also the issue of attention. Constant trading requires constant monitoring. Watching every price move creates stress, fatigue, and emotional exhaustion. Under those conditions, decision quality declines. People start reacting instead of thinking. They chase moves that already happened. They exit positions too early out of fear or too late out of hope. Activity creates noise, and noise clouds judgment. The market doesn't require constant engagement to deliver returns. In fact, history shows that long periods of inactivity often outperform frantic participation. Some of the best performing portfolios are the ones that are touched the least. That's not accidental. Fewer decisions mean fewer mistakes. Fewer mistakes mean better long-term outcomes. Another problem with constant trading is that it narrows time horizons. When you're focused on the next hour or the next day, you stop thinking about the next year or the next decade. Short-term thinking magnifies volatility and makes temporary fluctuations feel permanent. Long-term thinking does the opposite. It puts noise into perspective. Institutions spend enormous resources designing systems to reduce unnecessary trading. They set thresholds. They require justification. They impose limits, not because they hate action, but because they respect cost. Every action must earn its place. That mindset is completely missing from most retail trading behavior. There's also a behavioral trap at play, the dopamine cycle. Wins feel good, losses feel bad. Both create emotional stimulation. Over time, people begin trading not for returns, but for feeling. This is when trading starts to resemble gambling. Decisions are no longer driven by analysis, but by the need for excitement or recovery. At that point, returns become secondary. True investing discipline looks boring from the outside. It involves long stretches of inactivity, punctuated by rare moments of decisive action. It requires the confidence to sit still while others panic or chase. Most people underestimate how difficult that is. Doing nothing when everyone else is doing something feels wrong, even when it's right. And the uncomfortable truth is that most people would perform better if they traded far less, fewer positions, longer holding periods, clearer rules, lower expectations of constant success. But that requires humility, the acceptance that you don't need to participate in every move to succeed. And activity gives the illusion of control, but control in markets is limited. What you can control is behavior, how often you act, how much risk you take, and how patient you're willing to be. The market is full of noise, but wealth is built in silence. That's one of the hardest lessons for people to accept. Short-term trading feels exciting, it feels active, it feels intelligent. Long-term thinking feels slow, boring, and uncertain. Yet history is very clear about which approach actually works. Short-term excitement feeds the ego. Every trade feels like a decision, every decision feels important, and every outcome feels personal. Wins create adrenaline. Losses create urgency. This emotional cycle keeps people engaged, but engagement is not the same as progress. In fact, excitement is often the signal that risk is being misunderstood. Long-term thinking, on the other hand, requires restraint. It requires accepting that you will not capture every opportunity. It requires the humility to admit that you cannot predict short-term market movements consistently. Most people struggle with this because it conflicts with how they want to feel. They want certainty. They want control. Markets offer neither. The most successful investors understand that time is the real advantage. Compounding does not require brilliance. It requires survival. Staying invested through cycles, volatility, and uncertainty matters far more than perfectly timing entries and exits. Missing a few of the best days in the market can destroy long-term returns. Yet, short-term trading increases the chances of exactly that mistake. Short-term focus magnifies randomness. Markets move for countless reasons in the short run, many of them unrelated to fundamentals. Trading these movements assumes that noise can be consistently predicted. It can't. Long-term investing shifts the focus away from noise and toward value creation, productivity, earnings, and growth over time. Melenger, there's also a psychological benefit to long-term thinking that most people underestimate. When your horizon extends years instead of days, volatility becomes less threatening. Price drops are no longer emergencies. They're data points. Temporary losses don't feel like failure. They feel like part of the process. This mindset reduces emotional decision-making, which is one of the biggest drivers of poor outcomes. Short-term traders often confuse volatility with opportunity. Long-term investors see volatility as the cost of admission. You cannot earn long-term returns without tolerating discomfort. Trying to avoid discomfort usually leads to worse decisions, not better ones. Another advantage of long-term thinking is alignment with reality. Businesses do not create value overnight. Economies do not grow in straight lines. Innovation, productivity, and competitive advantage take time to develop. Investing with a long horizon aligns capital with how the real world actually works. Short-term trading often turns investing into prediction. Long-term investing turns it into ownership. That difference matters. Owners think differently than traders. Owners care about balance sheets, management quality, cash flow, and durability. Traders care about price movement. One mindset builds wealth, the other chases it. Institutions and successful capital allocators design strategies around long-term outcomes because they understand their limitations. They know they will be wrong sometimes. They plan for it. Risk management, diversification, and patience are tools to survive uncertainty, not eliminate it. Short-term excitement encourages overconfidence. Long-term discipline encourages humility. The market rewards humility far more consistently than confidence. Confident people take larger risks. Humble people manage them. Another critical factor is decision fatigue. Short-term trading requires constant decisions. Over time, the quality of those decisions declines. Long-term strategies reduce decision frequency, which improves decision quality. Fewer decisions made with clearer thinking often outperform frequent decisions made under stress. Long-term thinking also protects against trends and narratives. Markets are full of stories, new technologies, new sectors, new guaranteed opportunities. Short-term traders chase narratives. Long-term investors evaluate them. They ask whether the story is supported by fundamentals and whether the price already reflects the excitement. Tom Diance, most people underestimate how destructive impatience is. Impatience leads to selling too early, buying too late, and constantly switching strategies. Consistency disappears. Results follow. Wealth is not built by being right all the time. It's built by being reasonable most of the time and avoiding catastrophic mistakes. Long-term thinking minimizes the impact of being wrong. Short-term trading magnifies it. The irony is that long-term investing often looks obvious in hindsight but feels uncomfortable in real time. That discomfort is why it works. If it were easy, everyone would do it. They don't because excitement is more tempting than patience. The market does not exist to make you rich. That idea alone, if truly understood, would save most people from years of frustration and losses. The market exists to allocate capital, to price risk, and to reward patience, discipline, and sound judgment over time. Everything else, excitement, shortcuts, constant action, is noise layered on top of that reality. Dom Bans, most people enter trading with the wrong expectations. They believe intelligence guarantees success. They believe effort guarantees results. They believe being busy means being productive. Markets dismantle those beliefs quickly and without apology. Intelligence helps, but it is not enough. Effort matters, but only when directed correctly. And busyness, more often than not, is a liability. Preena, throughout this discussion, one pattern should be clear. Losses rarely come from a single bad decision. They come from repeated small mistakes driven by emotion, impatience, and overconfidence. Trading exposes human weakness not because humans are incapable, but because markets are unforgiving. They don't care how confident you feel, how much research you've done, or how badly you want to be right. Ben, the uncomfortable truth is that most people are not wired for constant decision-making under uncertainty. Fear and greed distort judgment, ego delays accountability, impatience accelerates mistakes, and information overload convinces people they're informed when they're actually overwhelmed. None of this makes someone unintelligent. It makes them human. That's why activity feels productive but quietly destroys returns. Every unnecessary trade introduces friction. Every emotional reaction creates cost. Every attempt to outsmart short-term noise increases exposure to randomness. Over time, those small leaks add up. The result isn't dramatic failure, it's slow underperformance that people often don't recognize until years have passed. Banished information, once considered an edge, is now a commodity. Everyone has access to the same headlines, the same charts, the same indicators. Acting on them does not create advantage. Judgment does, time horizon does, risk management does, the ability to ignore irrelevant noise does. Those qualities are far rarer than access to data. Long-term thinking is not a strategy. It's a mindset. It requires accepting uncertainty without demanding constant validation. It requires patience in a world that rewards speed. It requires discipline when excitement is taken. And most importantly, it requires humility, the recognition that you don't need to participate in everything to succeed. Bling to the market rewards endurance more than intensity. Those who survive volatility, manage risk, and stay consistent through cycles are the ones who benefit from compounding. Those who chase excitement eventually pay for it, not always immediately, but inevitably. LMDs, what separates successful capital allocators from unsuccessful ones is not prediction, it's preparation. Successful investors design systems that protect them from themselves. They reduce decision frequency. They impose rules. They think in years, not days. They accept that being wrong is part of the process, but being reckless is optional. But most people focus on returns before they focus on survival. That's backwards. You don't build wealth by maximizing gains. You build it by minimizing mistakes that take you out of the game. One catastrophic error can erase years of progress. Long-term thinking is how you avoid those errors. Glamps, there is nothing glamorous about patience. There is nothing exciting about restraint. There is nothing entertaining about doing nothing. Yet those traits consistently outperform brilliance without discipline. Markets don't reward who shouts the loudest or trades the fastest. They reward those who stay rational when others don't. And if trading feels stressful, overwhelming, or addictive, that's not a sign you need more information. It's a sign your approach is misaligned with reality. Markets do not require constant attention to deliver results. In fact, excessive attention often makes results worse. The hardest skill in markets is not analysis, it's behavior. Knowing when not to act, knowing when to wait, knowing when to accept uncertainty instead of forcing certainty. That skill is invisible, undervalued, and essential. Wealth is built quietly, slowly, unevenly, often boringly. The people who succeed are not those who try to win every day, but those who avoid losing badly. They understand that compounding only works if you give it time, and time only works if you stay disciplined. Them as the market will always tempt you with shortcuts. It will always offer excitement. It will always reward impatience briefly before punishing it severely. Long-term thinkers see through that illusion. They don't need constant confirmation. They trust process over prediction. But at the end of the day, trading doesn't destroy money because markets are unfair.